flow is why MicroStrategy has held onto it's a portion of its NAV premium.
We don't pay attention to indexes, so I've never thought about this. This is quite illuminating, Tom.
Yeah, imagine this. If you look at the cap table of Bitmine today, maybe there's 10 institutions, but then there's going to be 1,700 that have to decide whether they want to underweight. But equally important, as you know, Ethereum, because it's a smart contract platform, and then the role we're playing within both the community and with the rails, you can see us that we look more like a financial intermediary, which by definition is a bank.
In 2020, Bitcoin was still seen as a fringe asset. Ethereum was a platform for developers, not financiers, and few believed traditional finance would ever integrate with blockchain. Fast forward to 2025, and the world looks radically different. Today's discussion between Tom Lee of Fundstrat and Cathie Wood of ARK Invest isn't just another talk about crypto. It's a profound look at how Ethereum, tokenization, and passive index flows are reshaping the global financial system.
And so we should trade at a premium to book value. And there is an ability to add light touch, not the lightly regulated operating businesses that don't consume capital. And the ETH staking, will generate, even just on the current ETH, close to 400 million of pre-tax net income with zero debt on the company.
So Tom, I have been away from investing in traditional banks for a very long time. What is the multiple to book value, and why would you even put yourself anywhere near their orbit, since this world we're talking about is going to completely disintermediate them, right? I mean, that's a bit of an exaggeration, but is going to be quite disruptive.
Yeah, Cathie, I think I might bookend two companies, and then we can put everybody somewhere on the curve. But the two largest banks in the world now are Tether and JP Morgan. And JP Morgan trades at, I believe, over two times tangible book.
Okay.
But they have 330,000 employees, which is their largest expense. And in an AI and blockchain world, they may go down to 20,000 employees. So the JP Morgan likely re-rates in the future towards being a technology stock.
Yeah, no question. This is going to be a little bit like what happened in retail. So Walmart and Costco re-rated as the rest of the industry was being destroyed, right? Or consolidated away, right? That is what we expect to happen. So the other end of the spectrum, so that was JP Morgan.
Yeah. And as you point out, Costco and Tether, Walmart trade at 35 to 50 times forward earnings, which is higher than even NVIDIA's multiple, which I
Yeah. I know. It's pretty wild.
Now, Tether's tangible book is quite low, and it has a vastly more profitable business because it is very light employee intensive. The employee intensity is low. So if that price to book, let's say, is an exponent, a log function of JP Morgan's 2 to 3 times, which is rising, then that means that crypto treasuries shouldn't trade at 2 times NAV that are involved in the ecosystem. So in other words, the Bitcoin treasuries are designed to be inert. MicroStrategy is an inert holder of Bitcoin, but Bitmine is active and engaged in the Ethereum ecosystem. So it'll trade more like a financial intermediary, but JP Morgan and Tether are the bookends. I think that's why that multiple of the ETH holdings will actually rise over time for the winner take most. There's power law at work, which is, there is a level where if an entity owns too much of a network, they actually have a negative effect because they're crowding out innovation. We spoke with a few researchers, including Fundstrat, and then folks like Jeffrey Kendricks at Standard Chartered. 10% is actually still an acceptable level, because if you think about, even in any competitive world, if someone has 10% of a system, they aren't in control of it. There's, I don't know if you remember the Herschel-Hurtendel HHI index. And if you run that calculation, especially with 70 DATs, And then in DeFi, it's not a concentrated market. It would still be considered highly competitive. So I think up to 12 million Ethereum tokens isn't crowding, and that's double Bitmine's target. Besides Bitmine, however, as you know, other crypto treasuries have not even been able to secure 1% of ETH. And part of it is that you need the public to provide you the trust through the velocity and trading volume of the stock in order to get there. So I think that there isn't going to be DATs controlling 50% of the Ethereum network.
Right. But what is it like? You're saying it's okay for a single entity to own 10%, and you could have other DATs like down stack. So collectively, it could be something like 15 or 20%, maybe.
Yeah.
I mean, does that sound?
It's still a TBD because, for instance, Bitmine is now actually, believe it or not, I think the 470th largest company in America in market cap. And if you look at staking, because we'll announce our staking solution very soon, but assuming a 2.79% yield on a pre-tax net income basis, it's like the 800th most profitable company in America. Right? It will be global because Bitcoin and Ethereum are held globally. And MetaPlanet has certainly shown it's super differentiated in Japan. But the dynamic is the same because Bitmine and MicroStrategy will soon be Russell 1000 constituents. MicroStrategy already is, so that opens up to passive index flows, because that means now 1,700 large cap managers now have to make a decision on whether to overweight, underweight the 480th largest company in America. And that's why Bitmine, I think, could actually have accelerating flows next year and support.
Cathie also dismisses the idea that corporate blockchains, the so-called private chains created by banks, can compete. She calls them fat fingers on the scale, pointing out that centralized control will always skew outcomes in favor of the operator. Public chains like Ethereum, by contrast, are trustless, transparent, and global.
It's so interesting to watch this because, the idea that indexation is going to be a phenomenon here is mind-blowing to me because, when we first started this journey in 2014-15, we were considered raving lunatics. And even within the last few years, they were able to hide behind regulators who were hostile. It's really only now, and it's 2025. For the first time, index players are going to have to make this, or benchmark sensitive players, I should say, are going to have to make this decision. That's so interesting. It's going to force education into the market, kicking or screaming.
That's right. And then we already have crypto native companies like Circle and Figment and Bullish that are actually highly profitable and in some ways more attractive than the traditional counterpart. And so it is a very different world today than it was when MicroStrategy took the bold step of buying Bitcoin. I think definitionally, if Ethereum is not the long-term winner, then the company's leverage to Ethereum could trade at a discount to NAV because there is now a liquidity unwind or a discount to the future, which would say that if Ethereum is a dead chain, then all the holders of Ethereum should trade at a discount.
So Solana making a go is a risk out there, but institutions signing on to the Ethereum network is a big vote of confidence, right?
Yes. If you were to look at where the development is today, especially L2s and announced, even including like Swift building on Linea, Ethereum has already won the discount to the future. Because it is 100% uptime network. And I have gotten the clear sense, spending time at Token24 now with a lot of the Ethereum founders, that they are really listening to make sure they're going to do the upgrades that allow Wall Street to build on Ethereum. So I think it's a change of views. There's just two observations to make, and then I'll make a broader statement. But as you know, corporate chains are always going to be viewed as fat fingers someone's fat finger on the scale. And that's just how Wall Street operates anyways. If some bank created a layer 1 blockchain and they're the oracle, we know that they're tilting that in their favor. And of course, the second is that all blockchains are basically databases, and the security model becomes a question because it's either a centralized chain, which isn't really a blockchain, or it's got a security model that can be exploited. And we know there's so many high-profile hacks that have taken place. And uptime is a third dimension because, as you know, that is one of the prominent features of Ethereum, that its entire history, resilience was an existing feature and it's never had any downtime. And I think that that's important when we're thinking about a world of high-speed transactions in a 24/7 world. I think a lot of creativity needs to take place on layer 1s. And, to me, as we think about tokenized world and using prediction markets, a lot of that thinking is taking place around building on layer 1s and layer 2s on Ethereum. But a broader statement I'd make is I don't think one blockchain can hold the entire financial system anyways, because let's say your 27 trillion is correct, and I believe it is even conservative, because today global GDP is 80 trillion. And we know GDP is an imperfect measurement because it only measures final sales. So let's say it measures 120 trillion of gross activity is what 80 trillion is measuring. Financial system ledger is 120 trillion on the other side of that. If just half moves onto the blockchain of the financial transaction, that's a 60 trillion market. Plus, we know that as you tokenize loyalty and IP, things that are GDP measurements but not financial markets, that's also on the blockchain. So maybe the total, what ends up on the blockchain is 60 plus 20, 80 trillion market versus your 27 trillion. That cannot fit on one ledger.
Sure.
Element, which I know you guys talk about, which is, as we try to offset wage loss from AI, we will want to have a record of taxing agentic activities to replace that lost revenue. And that's a huge accounting system that is really working on public chains. And so, so 27 trillion seems very reasonable, maybe low.
As AI replaces human labor, agentic activities, automated, AI-driven economic functions will need to be taxed and accounted for. That requires transparent, programmable ledgers, a job tailor-made for public blockchains like Ethereum. This is not just about money, it's about the infrastructure of civilization.